Welcome to today's Authors of Google Talk. Mathew Padilla is a real estate and mortgage reporter for the Orange County Register. The editors of OCR submitted for the Pulitzer Prize his and two other colleagues' work on the implosion of the Southern California subprime industry. He also hosts a Mortgage Insider blog website. The blog has been featured on CNBC, MarketWatch, and editor and publisher. Padilla is a regular business news commentator on KOCE and KDOC television, and he's here today to talk about the book he has co-authored with Paul Muolo, Chain of Blame: How Wall Street Caused the Mortgage and Credit Crisis. Please welcome Matt Padilla.
Thank you. I'd like to start off with a sound check. Can you all hear me okay? It's an honor to be here at America's premier software company. And I hope by saying that I don't lose potential book sales to employees of Microsoft. I understand that the last speaker you had on the subprime crisis just won a Nobel Prize, so lower your expectations. My speech is called The Credit Crunch in You, and what I would like to do is go over what we have found in our book and also tie in current events so that by the time I'm done, you'll really understand just how horrific the current situation is. We are at a crossroads in this country where we will reevaluate how we borrow money. Our book is a narrative, which means we put you into the heads of people who ran companies, very big companies, and show you what they were thinking and why they did what they did. And we also try to throw in funny anecdotes to make it easier to read and follow. But I do think that by the end of our book, you really get a sense of how we got into this mess and where we go from here. One of the sources for our book, who asked to remain anonymous, he said, "The mortgage business is the only business I know where you make a ton of money in 1 year, and then you give it all back over the next 3. And how many companies can we think of that actually fit that description? Countrywide, the largest home lender in America, was forced to be sold to Bank of America. Washington Mutual, the largest savings and loan, was seized by the government and then sold to JP Morgan Chase. Lehman Brothers, bankruptcy, Bear Stearns, for sale, and on and on." Once again, our book is a narrative, and our focus is Angelo Mozilo. How many people in this room know who Angelo is? Just raise your hands. Oh, only a fifth. Angelo was the chief executive of Countrywide Home Loans, the largest lender in America. At one point, 1 out of every 5 home loans in this country went through him and his company. He built it up over a 40-year career, and we tell his life story in our book. Angelo grew up in the Bronx in New York. His dad was a first-generation Italian who owned 2 butcher shops. And Angelo grew up around the 1940s and 1950s in the Bronx. He was a tough guy. You know, we tell stories about his youth to help you understand what it was like for him. In one of the short passages, Angelo talks about how he had an ear infection, actually a mastoid infection, and they had to do 3 surgeries. And in the last surgery, they cut away part of his ear. And then if that isn't enough, he was only about 2 years old at the time. He talks about as a teenager, when he was about 14, how he worked in his dad's butcher shop. And I'll just read a graph from our book here. He didn't learn the story of how his father had sold one of his butcher shops to pay for the surgery until much later, when he was 14 or 15 years old. By that time, he'd been working in the remaining butcher shop, sweeping the floors and learning the trade, which included cutting up chickens and making sausage. He wasn't afraid to get blood on his hands. Butchers who were afraid of blood were worthless. I was a pretty good butcher, he says. Now, not being afraid to get blood on your hands, is that a metaphor for the future? I'll let the reader decide. Angelo wanted to work on Wall Street, like a lot of people who grew up in New York. But he had this perception that as an Italian, he might hit some kind of ceiling where he wouldn't be promoted all the way to the corner office. So instead, he followed his early days. When he was a teenager, he went to work for a mortgage company in the New York area, and he basically ran errands for them. And he was very good and very quick. He learned this whole business of how you make a home loan, the process, how you network to get customers. And he and a partner, David Loeb, started Countrywide. In those days, he sold the loans he made to Fannie Mae. How many people here know what exactly Fannie Mae is and what it does? Let me see a show of hands. One more show of hands. Oh, all right, maybe a fourth, which is good. I will get more into Fannie Mae later, but Fannie Mae is a government agency that buys home loans from banks, so banks have cash to make more home loans. In the beginning, Fannie Mae only did government-sponsored loans, so Angelo had to make those loans and sell those to Fannie Mae. It was a very low-margin business, so he was always watching for costs in the beginning. So he would travel around to motel rooms, cheap places to stay, and hold the interviews right there in the motel. Now, this is the 1960s, before the personal computer, if you can imagine such an era. And if you've ever gotten a home loan, you know there's a lot of paperwork, right? There's documents and documents. So Angelo liked to hire women because he felt, this is his perspective, not mine, that women can type. Right? So I just will read a quick paragraph here. Finding women to man the offices could prove difficult. Mozilo was driving around the state, opening up new branches in towns and cities where subdivisions were quickly sprouting up. He would conduct employee interviews in motel rooms. I set the interviews up in motel rooms because I was coming into town and needed a place to stay, he said. Sometimes the rooms would have suites, but not always. I had to laugh. A lot of time there'd be men standing in the doorways pacing. I remember one guy, I thought he was going to lose it, hit the wall with his fist or something. Just a funny anecdote to show that in the beginning, the mortgage business was a very low margin business where you had to watch your costs. It was very important to keep costs low. I would like to segue here into explaining a little bit more about Fannie and Freddie. And I would like to share with you some frustration that Paul and I, my co-author, have. Right now, if you've been watching CNN or listening to radio talk shows, you've probably heard certain Republicans or libertarians blame this crisis on Fannie Mae and Freddie Mac. And the reason is, from their perspective, Fannie Mae and Freddie Mac were created by the government, and then they were privatized, but they were still regulated by the government. And so people who believe in free markets think that they had an unfair advantage by being sort of quasi-government backed. In other words, people always assumed if they failed, the government would step in, which is exactly what happened last month. The government stepped in and took them back. But I want to express to you in no uncertain terms that it is not the fault of Fannie and Freddie that we are in a global credit crisis. Fannie Mae and Freddie Mac have always been limited in the size and the kinds of loans they can buy, mostly to people with good credit who pay their bills. The most recent reports that showed how many people were 90 days behind on their mortgages showed Fannie Mae and Freddie Mac both at close to 1%. The Mortgage Bankers Association figures from June, which are the most recent, showed that for all people with good credit, it was probably about 2.5%. And for subprime, these are the loans Wall Street made. Firms like Lehman and Bear and Merrill, 18% 90-day delinquencies, and that is not including foreclosures. If you added foreclosures, we'd probably be at 30%. So get this through your head. The next time you hear some pundit saying it's Fannie Mae and Freddie Mae's fault, kick your TV or call up the show and help us get the word out there. Don't confuse the issue. The culprit is Wall Street. And you can read about it in our book, which I hope you all share. But it is important to understand where Fannie Mae came from. And you're going to find that all roads lead back to the Great Depression. Now, there's been a lot of talk about this credit crisis and will we have a depression? I don't think we will. I think the government has a lot of tools and that the economy is a lot more solid and diverse. However, there's a lot of important lessons to learn. One thing is that during the Great Depression, we had 20% unemployment, and it's estimated that half the home loans in this country were delinquent. Would you want to make a home loan in that kind of environment where you wouldn't know if you would be paid back? No. The government felt it had to step in, and it did two key things. It created the FHA program, the Federal Housing Administration, as an insurance. So if you get an FHA loan, you pay into the insurance pool, and those premiums, like with health insurance, go to protect a lender against loss. So if somebody else doesn't pay their FHA loan, the pool pays the lender. If the premiums aren't enough, the government would step in and back FHA loans. Okay, that was good, but it wasn't enough. We needed more because banks didn't have capital during the Great Depression. So the government created the Federal National Mortgage Association, known as Fannie Mae, to buy the FHA loans and hold them. All right? So Fannie Mae would issue bonds, just straightforward bonds, not mortgage-backed securities, and use that debt to invest in FHA loans. And by doing that, created the secondary market. All right? I can't express to you how monumental this has all become. The secondary market is the market where loans are sold. The primary market is where you go to the lender and get the loan. Today, it's estimated that there are 10 trillion in loans on all of our homes, about the equivalent of the national debt. Of those, 5 trillion are owned or guaranteed by Fannie Mae and Freddie Mac. Banks probably hold 2 to 3 trillion on their books, and the other 2 to 3 trillion are the bonds that the Wall Street firms made and sold. So in other words, think about this logically. Banks like Bank of America and Wells Fargo, they're only accounting for 20 to 30% of all the loans made in this country in terms of holding them on their books. That means that we need the secondary market now. We've become addicted to it, eventually, basically. Anyway, the last 2 points were just Fannie Mae and Freddie Mac were privatized and spun off, and in 1970 they were allowed to buy a wider array of mortgages, not just government-backed loans like the FHA. One more history lesson is necessary here, and that is the savings and loan crisis. And then we can move forward to the modern era. But before the secondary market fully took over, savings and loans would make you a loan based on deposits in your area. So you would go to the Bailey Building and Loan, like in It's a Wonderful Life, give them money for a savings account, and they would use that money to make a home loan. That worked very well, especially after World War II, when we had a good, stable economy. It came to be known as the 363 business, because you would pay 3% on the savings account, make a home loan at 6%, and hit the golf course by 3 o'clock. A no-brainer. Inflation in the 1970s hit the S&L business like a hurricane. Nothing erodes wealth or causes more headaches for holders of bonds than inflation. Initially, savings and loans were only allowed to pay 5.5% on savings accounts. And this is one of the misguided government regulations, because the government wants to keep mortgages affordable and available. So they thought, well, if the S&Ls can only pay 5%, maybe mortgage rates will only be 6 or 7%, and that's great. What happened during the 70s was, well, if this money market pays 10% and inflation's at 10%, where do you want to put your money? In the money market. So deposits were flowing like a flood out of the S&Ls. Now, here's the thing about government. We could have let some S&Ls fail at the end of the 70s and the beginning of the 80s and paid a few billion in taxpayer funds, but that's not what we did. What did Ronald Reagan do instead? He deregulated. Ronald Reagan and members of Congress felt that if they opened the doors and let savings and loans invest in other things, not just home loans, then entrepreneurship and innovation would save us and avoid the taxpayers having to pay a few $billion. The opposite happened, as we now know. Savings and loans were taken over by certain people, like Charles Keating, who thought, instead, I'm going to invest in junk bonds and commercial real estate. And I'm going to own a development company. So the S&L is going to fund my development deal, and I'm going to pay myself a nice fee. And if the development deal goes south, I don't care because the S&L is federally insured, FDIC insurance. Not my problem. In addition, the government allowed the S&Ls to have more brokered deposits. And I don't know how many people here know what a brokered deposit is, but in a nutshell, there are brokers out there who shop around every day looking for the highest yield for their investors. So say this S&L is paying 5%, we'll give him huge blocks of cash, and if this S&L is paying 7% tomorrow, we'll move that cash into the next S&L. That's a brokered deposit. So Charles Keating could just ramp up on brokered deposits by paying 8%, fund his development deal, pay himself a fee, and not just Keating, there were others. And what ended up happening is the whole pyramid scheme collapsed, and it cost taxpayers $150 billion. Some estimate even more than that, if you counted interest. So deregulation took a little problem and made it into a much bigger problem. Now, I'd like to bring this back to our good friend, Angelo Mozilo, who's the core of our narrative. In our book, we're dealing with a lot of complicated concepts, but by telling Angelo's story, I think we help you follow along. Angelo was a real smart guy, and he thought that the collapse of S&Ls was good for him because it eliminated his competition, and he figured he could use the people who were being laid off. Basically, he looked at it this way. Mortgage brokers were this new thing in this country, relatively new. I mean, they always existed in small numbers. But Angelo thought, if people are being laid off by savings and loans, they have all this experience. They've been in the business for years. And in addition, they know real estate agents. So they have a customer network, and they could bring him customers. So he figured, why don't I pay the S&L people as contractors a fee? So they bring me a loan, and I pay them 1% of the loan amount. And I don't have to pay their health insurance or any of that other stuff that comes with full-time employment. Those independent people became mortgage brokers. So with Angelo, we saw the beginning of the network that we built to in the modern era, where you the customer, you go to the mortgage broker brings that loan to the banker like Angelo, and then Angelo sells it to a Wall Street firm like Merrill or Bear. Angelo's partner, David Loeb, didn't agree with that. He was concerned about quality. If the mortgage brokers are third parties, are we really sure that they're bringing us a well underwritten loan? We don't even know who their customer is, really. And some might be crooks, frankly. in any business, most people are good, some are bad, so you have to be very careful. Well, they went forward with the mortgage broker business model, and Angelo became one of the biggest users of mortgage brokers in this country and helped to build up the modern network of broker, banker, Wall Street firm. Here's a much harder quiz. How many people here know Roland Arnall? Raise your hand if you've ever heard of Roland Arnall. Maybe one in the back? No? Just a guy stretching his arm? Roland Arnall did not want you to know his name, but as we say in our book, he is the godfather of subprime. How about this? Ever heard of AmeriQuest Mortgage? Raise your hands. Ah, that's his company. All right, almost half the audience. You may have seen the Super Bowl commercials that were popular during the housing boom. Don't judge too quickly. Roland Arnall did the same thing that others did. When Ronald Reagan deregulated the S&Ls, he grabbed one, Long Beach Mortgage, and he used it to fund his commercial projects. Now, his projects were more or less viable, meaning he wasn't a crook. But then, when S&L started to go so wrong in the late 80s, the government suddenly woke up. This was kind of at the end of the Ronald Reagan era, and said, okay, you know what, on second thought, we shouldn't have S&Ls buying commercial real estate and junk bonds. They should go back to home loans. So what was Roland Arnall going to do? he bought the S&L to fund his commercial projects. Well, one of the things he did was, to meet with the regulation, he looked around for home loans that he could make and make a profit at doing. And he noticed that there were a couple of other smaller companies. One was Guardian Savings in Huntington Beach, where I'm from, in Southern California. And Guardian was run by Russ Jednek, a guy who made a lot of money as a pharmaceutical salesman, who also started an S&L. And he figured out that he could make a subprime loan, which is basically a loan to a person with a low FICO score. You know, whether or not you're prime or not is all based on your credit score. Prime is usually 700 or 720 and higher. And subprime is basically 620 and lower. And if you have a low credit score, it means you haven't paid some of your bills, or you have a lot of debt relative to your income. So guys like Russ at Guardian in the 1980s started to make loans to these people in a bigger numbers. And if they didn't pay, he would foreclose and take their home because home prices were rising during the 1980s. You know, one day, Russ had some guys over from Drexel, that's the Michael Milken junk bond firm, and he was talking about one of his projects in Texas that wasn't performing, and he wanted to turn that into a bond and sell it. He figured if it was a bond, then he could afford the debt payment on his apartment project in Texas. Well, the guys from Drexel said, hey, you know what, Russ? What else are you doing here? And he started talking about subprime, and they said, you know what? We've had some success with taking prime loans, putting them into a pool, we chop up the pool, and we sell those bonds to investors. I bet you we could do the same thing with your subprime loans. Hey, why not? If Drexel wants to do it, let him do it. So Russ made some money, and he also sold some of his loans to Roland Arnall, who needed to get into home loans again. Roland Arnall really saw that, hey, if Wall Street's going to buy this paper, I can make a lot of money. How do you make a lot of money on subprime? Yield, right? We live in a world where investors want to make the highest return on their money. And if you have bad credit, almost illogically, we think you should pay more money, right? Even though you probably don't have money. So, you know, Arnall figured, well, I can charge more fees and a higher interest rate to these borrowers. Then I can make bonds that have a higher yield, and Drexel can sell those. Well, Drexel would actually make them and sell them. Or Greenwich Capital, or Salomon Brothers, or any of the other early players in the subprime space. Roland Arnall first used mortgage brokers, just like Angelo. So mortgage brokers would bring him the subprime loans. Eventually, he sold his company off by taking it public And then that company was bought in 1999 by Washington Mutual. So Washington Mutual was one of the first big thrifts on a national scale to get into subprime. And we know what happened to Washington Mutual. They got seized by the government this year. Then he founded AmeriQuest, where he would make loans directly to the consumers. AmeriQuest became the largest subprime lender in the country. And it was known for really rewarding its employees very, very well. We wrote about some of the lavish spending in our book, just as an example, because it's fun. Okay. For AmeriQuest retail loan officers, the event of the year was a party at the Atlantis in Las Vegas called The Big Spin. ONeal would start the event off with a short 15-minute speech and then leave the honor to his top lieutenants, including Langs, the head of retail. At one big spin party in Arizona, sales managers witnessed the company giving away 10 cars, including Porsches, and $10,000 in prizes. Depending on the year, the entertainment included a cross-section of singers and actors, including LL Cool J, Penn and Teller, and comedian Jay Moore. The motivational speakers, designed to prime the sales pump, included former New York mayor and eventual presidential candidate, Rudolph Giuliani. I assume you've heard of him. Buffalo Bills quarterback Jim Kelly, boxer Sugar Ray Leonard, and others. The point is there was a lot of money because Wall Street was buying and selling these loans. The top people earned $2 or $3 million a year. Those are the guys who brought in the loans and earned a commission. You know, in Angelo Mozilo's model, you would get 1% for a loan. So if you made a $500,000 loan, you would pay the broker a 5%. If it was internal, the internal guy might make a similar commission. In the subprime world, the commission might be 2, 3, or 4%. Oddly enough, people were rewarded more for making loans to people who couldn't pay their bills. I don't know why. Or I do know why. It was because there was so much money. Eventually, AmeriQuest got in trouble for things. It had the largest settlement the second largest settlement in the industry in US history with almost every single state, 49 states. It paid $300 million. It did not admit wrongdoing, but basically the money was to go to people who may have been victims of things like upselling, where you have kind of borderline credit and you could get a prime loan, but because you went to AmeriQuest, they may have pushed you into subprime. Or maybe they promised you certain terms and then did a bait and switch. When you signed, terms were different. I mean, in our book, we cite an LA Times story, which is very good, which talked about one office where there would be guys with like a Coke machine, and you know how a Coke machine is lighted, and they would put a document with the customer's signature and another document and practice forging the document. Yield. All right. As we round out the speech, where it gets really interesting is when Wall Street suddenly decides, you know, I don't need Roland Arnall. I could own my own subprime lender, make the bonds, sell the bonds, and for companies like Merrill Lynch, even make the CDOs, which I'll talk about. The subprime lenders didn't have the Wall Street name because, you know, Wall Street didn't want to be really have its brand, you know, tarnished. So it wasn't like Bear Stearns subprime lending. It was, you know, EMC mortgage, or it wasn't Lehman Brothers subprime lending. It was BNC mortgage. Bear Stearns and Lehman were among the first, but I think the story is really interesting with Stan ONeal and Merrill Lynch. Stan ONeal is another one of these guys who is a self-made man. He was very sharp, one of the first African Americans to ever head a major Wall Street firm. He became the head of Merrill Lynch in 2002. He started off in General Motors as a finance guy, and then he moved over to Merrill Lynch on the finance side. At the time, Merrill Lynch was known for having a corporate culture that took care of employees. Employees called it Mother Merrill. Stan ONeal fired tens of thousands of people and sought to change that culture. And he looked for new profit centers. Among them was the subprime space. The thing of it is that when you're telling these stories and you're trying to explain to people why a human being who had built up a career over 40 years ruined it all on a gamble of people with a history of not paying their bills, his story is the story. ONeal had spent all this time rising to the top. Then he's under pressure to make profits for Merrill Lynch and show that he's growing the company. So in late 2006, he says, I'm going to buy First Franklin, a subprime lender, for more than $1 billion. You know, by early 2006 and even late 2005, as a reporter for a newspaper, I was already writing stories that subprime lenders were starting to get hurt because Alan Greenspan had raised interest rates. On top of that, in early 2006 to mid-2006, when a subprime lender like ONeal, Shop, or New Century would make a loan, it would go instantly bad. Meaning, I give you a loan and you miss the first payment. And then I have to buy the loan back as the lender because something's wrong. So why in the heck did ONeal in late 2006 get into the subprime space? Angelo was buddies with ONeal. They served on the President's Council and they golfed together. And here's what his reaction, meaning Angelo. When the news reached Mozilo, he was taken aback. He asked ONeal why Merrill was getting into his business, meaning subprime. It's part of our plan, was ONeal's reply. Mozilo knew exactly what the plan was. It was his plan. Countrywide originated subprime mortgages and securitized them through its own capital markets division. The only thing that Countrywide didn't do was create CDOs. They didn't want to come to us for loans, said Angelo. They thought they could manufacture it themselves. In a later quote in the book, Angelo says, I think ONeal thinks he's found a shortcut to the freeway of happiness. Near the end, Merrill Lynch got stuck with bonds and CDOs it couldn't sell. A CDO is a collateralized debt obligation. It's a little bit more complicated than a traditional subprime bond in that you set up a corporate entity for this CDO, and you sell bonds and an equity share in the entity, and you use that money to buy subprime mortgages or auto loans or credit card receivables, whatever you want to throw in that bucket. By 2007, mid-2007, Merrill Lynch had tens of billions of this stuff that it couldn't sell. It was a disaster. It was like a cancer on its books. Even in this last quarter, meaning right now, this week, Merrill Lynch has said something like another 10 or 12 billion in charges. So they've written down their assets on this stuff like $50 billion. And we don't know if they're done or if more is coming. Lastly, I'll just say, one of the fun stuff in our book was finding out how it all went wrong. And what we found was that the Wall Street firms knew the loans might be suspect, so they hired contract underwriters like Clayton Holdings and the Bohan Group to review the loans, and they would pay him a fee. The problem was, as pressure grew, they didn't let the contract underwriters do their jobs. So for example, let's say I'm Merrill Lynch and I go to some subprime shop and I say, okay, I'm going to have the Bohan Group review 50% of your loans to make sure they're up to snuff. And then the subprime shop would say, well, but Bear is only going to review 20%. Okay, I'll review 30%. So it was a race to the bottom. You know, on top of that, the companies themselves were growing so quickly that they were hiring people who weren't qualified, and they were pushing them to review at least one loan per hour so that the Bohan Group and Clayton would still make money. And I will read just a short clip here. Eileen Loyacano, a Bohan contract worker who worked on loans that Merrill and other Wall Street firms bought, told Padilla of the Orange County Register that the pressure was so intense to approve as many loans as quickly as possible that one of her supervisors, whom she would only identify as Robert, would frequently stand up on a desk screaming at the laptop worker bees, "Work faster or you're going to get fired." I personally think that it got to the point where the Wall Street firms were hiring these guys so that they could show the rating agencies like Standard & Poor's, Fitch, and Moody, "Hey, look, we've done the due diligence, just give us the AAA rating." To conclude, I have 2 more slides, so we have time for questions. In our book, we say 10 bad years for housing. We've already had 2, so 8 more. I don't expect home prices to slide for 8 years, but I do expect them to slide for the foreseeable future, and then just kind of hang down at the bottom of the pond. And the reason is foreclosures are through the roof. Even in my county, Orange County, which is a wealthy area, during the 90s, 600 a month was the most. We've had more than 1,000 a month of foreclosures for the last 4 months. Also, normally you get a recession first and then a housing market downturn. Now, because the lending was so bad, the housing market downturn has come first. Then we're going to get a recession, I firmly believe. People lose their jobs, can't pay the mortgage, more foreclosures, and the cycle. And the third is that Wall Street isn't buying loans anymore because nobody knows or trusts them. And as I explained earlier, the secondary market is the most important thing now in this country for home loans. So if Wall Street's not buying, and we're relying on Fannie Mae and Freddie Mac, there's only so much that they can do. Finally, let's wrap up with fixes. How do we fix this mess? Or really, how do we prevent it from happening again? One thing we've learned is that regulation is not such a bad thing. From the S&L crisis and from this era, you know, when you take Economics 101, they try and teach you perfect competition is good because you allocate resources efficiently. Well, in the mortgage business, because people could buy and sell these loans and make a loan to anyone who had a pulse, you had no barriers to entry. You had perfect competition, but that didn't prevent the industry from self-destructing. So you need to regulate. The smartest regulations out there, Congress is considering licensing every individual who works with a consumer on a home loan. You know, right now, this bill is kind of dead in the House, but if somebody wins the presidency, maybe it'll happen next year. In California, you need to go through more training to cut someone's hair than to give them a home loan. Mortgage brokers have to be licensed by the DRE, but you could get out of prison and go work for Countrywide tomorrow and make somebody a home loan. There's no legal requirement for a background check. The Glass-Steagall Act, you know, I would like to hang this all on Greenspan, who cut interest rates and did absolutely nothing to control the lax lending, and George Bush, who was sort of hostile to regulation, but I can't because Bill Clinton in 1999 repealed Glass-Steagall, a Depression-era law that says banks do this, insurance companies do this, and investment banks do this, and they are all separate. When Clinton repealed that with Congress, we got a free-for-all. Citigroup, which has just reported another loss, is one of these financial conglomerates that nobody knows what's on their books or what they're doing. So you either need to bring back Glass-Steagall and get rid of or break apart Citigroup and Bank of America and other such financial conglomerates, or you need a super regulator who has a big staff and can go through their books to protect us from a total financial meltdown. And regulate the stuff that nobody knows what they are, like credit default swaps. This is a $40 trillion market. $40 trillion is such a big number. Some people think it's 50 trillion. A credit default swap is an insurance contract. So I buy the subprime bond, and I figure maybe I'm not going to get paid, so I buy a default swap. They don't call it insurance because insurance is heavily regulated, so they call it something else. But it's basically insurance. And as you know, with life insurance, there's nothing preventing me from buying, let's say, $1 million bond and buying more coverage than I really need. So I could buy $1 million from company A, $1 million from company B, and $1 million from company C. So if my $1 million bond, I don't get paid, I can say, all three of you guys pay me $3 million. That's why it's $40 trillion, because who knows? That is just insane. AIG, which the government essentially took over by promising them this huge, I think it's $70 or $80 billion loan, they had a ton of this stuff on their books. And because people don't know really what that means, people lost faith in AIG. And that's a company that you may have life insurance from or some other insurance product. They do all kinds of insurance, but they don't call credit default swaps insurance. Hedge funds, we don't know what hedge funds are doing. We should regulate them, make them transparent. You know, the idea with hedge funds is that because you're a wealthy investor, you're sophisticated, so we don't need to regulate hedge funds. But you know, last year when Bear Stearns hedge funds went bust, that kind of started the whole credit crisis because we learned that they were leveraged 30 to 1. So for every dollar of subprime, they borrowed $30, so they would make more money. Except if the asset goes down, leverage can kill you. Finally, Fannie Mae and Freddie Mac are more important now than they ever were. If it wasn't for Fannie Mae and Freddie Mac, you couldn't get a home loan in this country today. So what do? The free market ideologues would like to spin them off totally into the private market. Paul and I really feel that that's not realistic. Maybe someday. A smarter thing would be to maybe chop them up into 4 or 5 regional companies, keep them as federal agencies, but regulate them like utilities, meaning I want to know exactly what you're making, and if you make a profit, let's use that money to pay off the debt, our country's debt. You know, and then maybe after 10 years, if it's realistic, you might be able to spin off those companies and privatize them. But in the foreseeable future, we need them. And that is it. So I have time to take questions. I have been asked, if you would like to ask a question, that you come to this microphone so you can be heard. So would anyone like to ask a question? Thank you. I'm around to sign book. Oh, wait, I have a question.
Well, yeah.
Go ahead.
Is this on?
Yeah.
Everybody here? OK. So I'm a free market ideologue.
OK.
So I'll take issue with pretty much everything you've said. Starting with your explanation of the S&L crisis, which you rightly characterized as the S&Ls getting reckless with lending due to deregulation. But you glossed over the fact that the reason that they were getting reckless with lending was because they were FDIC insured and had nothing to lose because the government was backstopping their losses. Same problem here with the subprime crisis and things leading up to it is the government backstopping losses creates scenarios for reckless lending. That's why Washington Mutual and all of the, I mean, without that, this would just be a problem of a lot of hedge funds and a lot of rich people losing a lot of money, which, you know, due to their foolish choices, which I presume you wouldn't have any problem with. The problem here is that the taxpayers are on the hook for it. And the reason the taxpayers are on the hook for it is because of the FDIC. Good.
Well, I will address the question. It is a fundamental question. Do we need FDIC insurance? And, you know, we're going to fundamentally disagree. I think that it's good because it avoids a run on the banks like we had during the Great Depression. But you are absolutely right. What it means is that borrowers, you know, consumers who put their money with a company like WAMU, they don't look closely enough at the type of loans that WAMU is making, which allows WAMU to make bad loans, which means taxpayers are on the hook. Now, in the case of WAMU, for example, they were able to find a buyer, JP Morgan Chase, so luckily we weren't on the hook for all that money. But you are right. It is a dilemma. But I think it's better for the overall financial system to have FDIC insurance because it prevents a run on the banks.
But it creates this.
Yes. Yes, it does. To a degree, you are correct. However, the companies like Ameriquest and New Century, who were 2 of the largest subprime lenders, they did not have consumer deposits. What they did was they borrowed money from Wall Street firms, made the loans, and sold those loans back to the Wall Street firms. So in their case, FDIC insurance was not a factor because there were no deposits. So you can't hang it all on FDIC insurance, but a part of it, yes. All right. How about another question? I am here to sign books. If anybody would like the book signed, I will be right here, and I just need a pen.
Question?
Oh, another question.
So why do things like the S&L crisis and subprime keep starting in Orange County?
Oh. This is a fantastic question. When I was writing for a smaller paper, the editor said, you know, Matt, you should start looking into these subprime companies, because I got a buddy who they had this lavish Christmas party where they gave away all these prizes, and it was, you know, the bomb. So I said, okay, I'll start looking into them. And basically what we found was that it's two things. Because the first were there, like Roland Arnall, guys who worked for Roland Arnall said, oh, well, I can just go next door and start my own company. One of them was Stephen Holder, who was one of the founders of New Century, which became one of the biggest subprime lenders in this country. So it was like cell division. Just because the first one was in Orange County, it was easy to do, it started to break off. And the other thing is, in California, we are a huge home market. You know, I think like 1/5 of all loans are made in this state. And we have nice appreciation along the coast, especially. So that's where the money is, and people want to be where the money is. So whether it's Orange County or LA, where Countrywide was in Calabasas, or even on the West Coast with WAMU, people want to be here in California on the West Coast. There's money here, and there's a big market here, and a growing population. I can do one or two more questions. Anybody else? You want to? No? Oh, you want to go? OK, I'm here. Thank you very much.